Hey guys, welcome back to another video lecture series dealing with Chapter 6. And Chapter 6 talks about variable costing and segment reporting. Now, these are two tools that management can use in order to, well, first figure out what is our unit product cost, and segment reporting allows us to see how much profit a specific segment might offer to the overall company. So we're going to break down these videos. As you see from the Moodle shell, this chapter really has 5 learning objectives. So in this video, we're going to go over variable costing, and we're going to see how it differs from absorption costing, and we're also going to see how do we calculate the unit product cost under each of those methods. Now, the good news is you already have the base of knowledge for variable costing, okay? Think back to Chapter 1. Remember, I said all this stuff builds on each other, right? So in Chapter 1, we really got our costs under control, right? Meaning our cost classifications. We talked about manufacturing costs. We talked about non-manufacturing costs, right? Remember, our non-manufacturing costs are the selling and administrative costs, okay? Those will not change. Selling and administrative will always be non-manufacturing costs. We said the manufacturing costs were our direct material, direct labor, and manufacturing overhead, right? And we said those 3 costs go into determining what it costs us to make a unit of production, or what it costs us to provide a service, okay? So we're still going to be working with that idea of DM, DL, and MOH. We saw in Chapter 2 and as well as Chapter 3, when we got into job order costing, we said, okay, this manufacturing overhead, right? We need to apply it, right? We said that our manufacturing overhead costs are all our indirect costs, right? Meaning they are not easily and conveniently traced to a unit or to a service. So, you know what? We have to allocate it based on that predetermined overhead rate, okay? Now we're going to jump into we're going to jump into variable costing. Very, very, very similar to absorption costing. Before we jump into talking about what is variable costing, how does it differ from absorption costing, we need to go into this chapter with some assumptions. Okay. So the first assumption is that when we're looking at variable costs, when we're looking at variable costing. Variable costing uses actual costing rather than the normal costing approach that we used in that job order costing, okay? What they're talking about is they're talking about that element of manufacturing overhead. Manufacturing overhead was applied, right, based on some predetermined overhead rate. So here we're saying that, you know what? Actual costs are going to be used. So that means that we need to take all of our product costs, direct material, direct labor, manufacturing overhead. And if these are the costs that we actually incurred, we know that, well, wait a minute. In order to determine what actual costs were incurred, we had that cost classification of variable and fixed, right? So those are going to come into play as well, okay? Remember, variable costs change in direct proportion to changes in levels of activity. Fixed costs remain unchanged as long as we're within that relevant range based on production, okay? So that's number 1. We're saying that in number 1, actual costs rather than that predetermined overhead rate is going to be used. Okay, great. Also, we're going to start to look at the actual number of units produced, okay? we're going to use that as our allocation base for assigning the fixed manufacturing overhead costs, okay? So I want you to think back to Chapter 2. Chapter 2 said, okay, we have our direct material, direct labor, manufacturing overhead, right? Manufacturing overhead was applied on that predetermined overhead rate. To get that predetermined overhead rate, we had to estimate the total manufacturing overhead costs, and we divided by some allocation base. We used direct material. We used material cost. We saw that. We used direct labor. We saw that. We used machine hours as an allocation base. We saw that as well. In this chapter, we're saying because we're using variable costing, we're actually going to use the units produced as our allocation base. And that is how we are going to assign the fixed overhead, okay? And then the third assumption we're going to make in this chapter is that we're going to assume that the variable manufacturing cost per unit and the total fixed overhead cost per period remain constant, okay? So again, we're focusing in here on the difference between how we're going to look at variable costing versus absorption costing. We need to go into this thinking, okay, I know my manufacturing costs. I know that I can look at those manufacturing costs, direct material, direct labor, manufacturing overhead. I can look at those from a variable through a variable lens, or I can look through them through a fixed lens, right? We know how variable and fixed costs behave. So the three assumptions basically say we're using actual costs. Second assumption says we're going to use the actual number of units produced as our allocation base, okay? That's how we're going to assign that fixed manufacturing overhead. Third assumption that we're going to go into this chapter with says that, you know what? The variable manufacturing cost per unit and the total fixed manufacturing overhead cost per period are going to remain constant. They are not going to change, okay? So this slide is just beautiful, right? And it really talks about it really demonstrates rather the difference between variable costing and absorption costing, okay? And to really understand the difference between these two, we need to look at period costs and product cost. And we need to also think about the manufacturing and the non-manufacturing costs, okay, and how they basically are synonyms for one another. So let's look at variable costing. Let's pump the brakes here. Before we jump into that, I want to point out one important thing. Notice our costs, right? We have our manufacturing costs. We have our non-manufacturing costs. They take those costs and they say, okay, we're going to look at them through a different lens, right? We're going to look at them as, are they direct or are they indirect? Are they fixed or are they variable, okay? Direct material, direct labor, always going to be variable, okay? Manufacturing overhead, we pull it apart. We say, I want the variable manufacturing overhead and I want to show my fixed manufacturing overhead, okay? Product costs, if you think back to chapter was it 3, I believe, chapter 2, we did the contribution formatted income statement, right? And we said that, okay, we have variable selling and administrative expenses, and we also have fixed selling and administrative expenses, okay? Here, what we're doing is we're saying, okay, which of all these costs that we have, what are period costs, what are product costs? And the difference between variable and absorption costing is how we handle the fixed manufacturing overhead. It's the only difference, okay? Variable costing assumes that our product costs include only variable product costs, okay? Or only the variable manufacturing costs. That means direct material, direct labor, and variable manufacturing overhead make up the product costs, okay? Well, what do we do with the fixed manufacturing overhead? Well, only under variable costing, we say that, you know what, we're going to treat fixed manufacturing overhead, even though it is a manufacturing cost, because we're doing variable costing, we're going to treat that as a period cost, meaning we expense it when it incurs. So we're going to, under variable costing, we're going to include only fixed manufacturing overhead as a period cost, or we're going to lump it in with that selling and administrative costs, okay? It's the only difference between the two. For sake of review, let's just look at the absorption costing, right? What are our product costs? Well, direct material, direct labor, variable, and fixed manufacturing overhead. Okay, great. What are our period costs? Well, period costs are still the selling and administrative expenses, regardless if they're fixed or variable. They're selling and administrative. They are always period costs, always. Okay, so that's the main difference between variable and absorption costing. How do we handle fixed manufacturing overhead? Variable costing says, we consider it a period cost, meaning we expense fixed manufacturing overhead when it occurs. Variable costing says, or in addition to that, variable costing says we do not include fixed manufacturing overhead as part of the product cost. Okay? So that's, this slide's really, really important, really explains the difference between the two. If this is still a little confusing, we're going to go through some examples of how we actually calculate product and period costs, how we calculate the unit product costs under the variable costing method as well as the absorption costing method. So it should become a little clearer, but right off the bat, what's the difference between variable costing and absorption costing? It's how we handle fixed manufacturing overhead. Okay? So which method will produce the highest value for work in process and finished goods inventory account? Well, we have A, absorption costing, B, variable costing, C, they produce the same value of these inventories, and D says, well, it depends. I can tell you right now, it does not depend. There is a definitive answer. C, they produce the same value for these inventories. Nope, that's not correct because they produce different values. And as we go on, we're going to see how we get those different values. Okay? So the answer, which method will produce the highest value for our work in process and our finished goods inventory, it's going to be absorption costing. Okay? The reason why, it's because how we handle our fixed manufacturing overhead. Under the absorption costing, fixed manufacturing overhead becomes part of the product cost. It becomes part of the product cost that goes into the inventory account WIP, that goes into the inventory account finished goods. Under the variable method, fixed manufacturing overhead is treated as a period cost. Okay, it doesn't become part of the product cost. So that means that the inventory WIP account and the inventory finished goods account are going to be lower under variable costing. Okay, so let's look at an example here of how we calculate unit product cost. Okay, so here's what they give us. Harvey Company, right? We got a single product. They give us the following information. They tell us that we produce 25,000 units annually. Okay, great. They give us all the variable costing. Now, be very cognizant of what they're showing us. Variable costs include direct material, direct labor, variable manufacturing overhead cost. They also show us the the variable selling and administrative costs. Okay. Remember, under absorption costing, as well as under variable costing, selling and administrative costs never become part of the product cost. Never, ever, ever. Okay? They also give us the fixed manufacturing overhead costs of $150,000, and then they give us the fixed portion of the selling and the administrative expenses. Sounds good? So we need to figure out, what is the unit product cost? Well, under absorption costing, notice what we have. Direct materials, direct labor, variable manufacturing overhead, $10 per unit. Okay, that's the same under the absorption method and the variable costing method. Then we get to, then we get to the fixed manufacturing overhead cost. We need to figure out the per unit cost. Okay, very easy to do. I'm going to go back a slide for a second. They said that the total fixed manufacturing overhead cost was $150,000. That's the total cost. How many units do we produce? 25,000. So we're applying that total fixed manufacturing overhead cost to the unit based on the units produced, which is 25,000. So if we divide that 150,000 by the 25,000 units, we end up with $6. So that means that each product has $6 of fixed manufacturing overhead included in it. Okay? Under the absorption costing, fixed manufacturing overhead is not a product cost. It is a period cost. It gets expensed as soon as it is incurred. So look at the unit product cost. Under variable costing, it's $6 less. Why? Because of how we handle fixed manufacturing overhead under the variable costing method. Okay? So you could see the slide here states, hey, under absorption costing, all product costs, whether they're variable or fixed, are included when we determine the unit product cost. Under variable costing, only the variable production costs are included in the product cost. Very, very, very important. Very important to understand, again, and I know I sound like a broken record, how we handle that fixed manufacturing overhead and how we handle it under the various costing methods. Okay? When we come back in our next video, we're going to see how do we prepare income statements, using both variable and absorption costing methods. So tune back in for that one.